morning. I know Eric in Northport's out there somewhere, probably first in the chat. Do the Rockaway. We started watching the documentary last night. My wife was very excited about it. It's pretty dark. Anyway, moving on. What are we here to talk about? We're talking about morning momentum. We're talking about the runner. We'll talk about volume-weighted average price. Remember, I was going to talk about this stuff yesterday, and I booked a guest. I forgot that I booked a guest. Hey, that happens. It's Monday. But it is December 9th right now, and guess what? The Federal Reserve is going to be in play for the next 48 hours. I'm sure you know who they are. If you don't know who they are, Google me, Jerome Powell. Grant T. Nevers, Timothy coming in as well. Garrett, that'd be a good one. That'd be a good one. All right. So right now, real quick, futures. Flat, not a whole lot going on, obviously. We are on alert. We will talk a little bit about what's going on with Japan. We'll talk a little bit about what's going on with the U.S., but FOMC, Fed Open Market Committee, will meet over the next 2 days. Very antiquated way of centralized planning to get 12 people in a room and try to look at old data to try to forecast what's going to happen 8 to 10 months from now. But that's how the system works. We play by the rules and we adjust accordingly. Right this morning, silver is the leader of the harder commodity world, adding another 1.2%. Gold up to 4,200. We'll talk about why that is important in a moment. But as always, why are you joining us? Well, the next really 72 hours, there will be a lot of position, then unwinding. And that's really what this is about. This is not about people making bets on what the Fed is going to do. This is about people managing risk over the next 48 hours. So you're going to see some wilder, you'll see some swings and some big names. You'll see some rotation. You'll see a lot of potential put activity. And the question, of course, is, are people making bets against something or are they hedging? And in the case of some of these other names that we'll discuss, this is very critical, right? It's very important that people note that just because you see put buying does not necessarily mean that people are betting against a big downturn. They are effectively engaging in a hedging, right? Because the put that they are buying gives them a right to sell at a very specific price, the strike price, on or before the expiration date of that option. That's the key thing to keep in mind. So if I buy puts, it's not that I'm just betting something that's going to go to the downside. I have the right to sell the underlying asset. And if the stock that I buy is at $65, for example, and I buy a $60 put, and the stock falls to $55, I can sell that stock at $60 to the person who sold me that put. That's the key differential. So very important to keep this in mind. We'll talk about some of the stocks that are seeing a lot of activity. But again, this is about positioning where the smart money will be. We'll look at some screeners. We'll talk about volume-weighted average price because the 2:30 trade tomorrow may set up. I like that everybody's already quoting Warren Zevon. This morning, we had a very interesting jam band conversation for the last 20 minutes yesterday. Hey, I'm here for it. All right, momentum. So key thing here is that our Russell is strong on intraday. And our readings are strong on intraday, right? Momentum, strength on the left, intraday here. This is intraday as well. These are weekly readings. That's critical to keep in mind. The weekly, the daily and the weekly are what we are constantly focusing on. This stuff typically will reset on a Friday, but we obviously are measuring this at the end of each day. That's the critical nature of this reading. So the Russell is telling us something right now. Even though the Russell is sitting at 25, 21 near all-time highs, there is something happening in the lower portion of that world. And 53% of stocks are trading under their 50-day moving average, 47% under their 200-day moving average. And yes, we are seeing advancing and declining, and we're seeing new highs, but there are still a lot of new lows. 6 sectors are green. 5 sectors are red. And that's a very important thing to note because it just showcases once again that there is positioning ahead of time. And I'm going to walk you through what those sectors are at the moment because I just wrote about that. There we go. We have, let's see, add that. This is where we are right now. So consumer discretionary, staples, financials, technology, and utilities are all still under pressure right now. And it's not happening at the top of the S&P 500. It's happening in the lower region of the microcap stocks and the Russell 2000. All right, so as we move into this week, the reality is that the markets have largely priced in a Fed rate cut. Right now, CME Fed Watch is setting a odds of a cut tomorrow at 87%, which a lot of people think is a done deal. But the key thing to really watch is out into January for clues. And the odds of a second rate cut, taking us down into that specific range of 3.25 to 3.5, has been sliding. The odds of a rate cut this month or in January, taking us to 3.5 to 375 basis points, is at 65%, meaning the odds of a rate cut before for January or and December collectively is about 90%. Now, why does all of this matter? It matters because, once again, the Fed kicks this policy meeting off today, and markets are pricing a high odds of a rate cut this week. The futures are flat. Traders are avoiding big bets. They are starting to position. But it's important to note that there is justification for the Fed not to cut. There still is. And it's a little tiny country far, far away, the Pacific Ocean, known as Japan. The reason is Japan is losing its battle against inflation. It is also engaging in $117 billion in stimulus, and there is an 80% chance that Japan will need to raise its rates next week. Now, why does all of that matter? It matters because we've talked about this. It's the idea of what the carry trade is. The trade for the last 2 decades, 3 decades, has been to borrow money in Japan for 1 or 2%, maybe even less, and then invest it in U.S. equities. What you do is you pay back the 1% and you pocket the other 14 if the S&P 500 was up 15% annualized. That trade unwinds, and it becomes a deeper concern about what happens to U.S. equities when a lot of foreign money leaves. As we noted, we showed this chart. It was about 8 to 11% of all money in the U.S. equity markets was foreign dollars in 2008. That number is around 20% today. And why does that matter? It matters because if foreign money flows, cross-border capital flows leave the U.S., it starts to create pressure on that chart that we showed about valuation compression. What has driven the market for the last couple of years? Since 2022, since our liquidity bottom, valuation expansion. The argument goes that what drives equity prices is earnings. But in the last 3 years, since 2022, since the liquidity bottom in December of that year, after the British gilt crisis, it has been this purple area. That is valuation expansion. Only 5% of the gains can be justified through earnings, which means people are buying the same earnings flow for more. Valuation expansion means exactly what it sounds like. If we look at a company like, I don't know, MKC, McCormick & Company, Spice Company, grew up on this company. This stock was trading at 35 times earnings, I believe, earlier this year. But typically, historically, people would say, well, the S&P 500 should be somewhere in the range of 15 times earnings. I'm just throwing numbers out there. But then, because money has to go somewhere, an expansion of liquidity, the money has to go somewhere, people start paying more money for the same earnings. And as you can see, it doesn't end well. So here we are, the backseat. This is being driven by foreign flows. And then what happens? As momentum builds, passive investors, ETFs, load up on those stocks. Leverage funds load up on those stocks. But if that money leaves, that's going to impact the S&P 500. That's going to impact the SPY. It'll impact all of the passive ETFs. And that air will come out. Now, the United States media and everybody else will come up with a different reason for why it is. They'll call it this bubble. They'll call it the dot-com bubble or the housing bubble. They'll call it the Europe bubble, whatever they're going to call. At the end of the day, the simple thing to just keep in mind is that people stop willing to pay 50 times earnings, and they'll say, well, and that guy will turn and say, well, I won't pay 48. Another guy says, well, I'm not paying 46. And it goes like that. It's not so much a valuation bubble as it is a liquidity bubble. But what goes up will come down, and we are obviously at the most stretched we have ever seen on the Buffett indicator and a number of other indicators as well, or at least we're in range of where we are in the dot-com bubble. So that's why Japan matters so much. And that is why cross-border matters so much. This is not something that they teach. This is not something that is well talked about. I get it. But the reality is this. The Bank for International Settlements is the central bank of all central banks. And what they did in April was they explained in a report that nobody read, probably except for me, is the transmission impact, which means in the event that Japan does something, their central bank, the U.S. will feel it. It used to not be that way, but it all changed after 2008. So the Federal Reserve seriously cannot start to engage in policy decisions without checking in with Brussels, where the ECB is, London, where the Bank of England is, Ottawa, where the Bank of Canada is, Japan, Tokyo, Bank of Japan. What's happening in Zurich with the Swiss bank, all of this stuff is connected. And if the U.S. starts to make very aggressive policy decisions like they did back in 2022, other nations will feel it. And if Japan starts making something significant, other markets will feel that as well. So just be aware of this, be cautious about it, and if our signal goes negative, I'm serious. I believe it is going to be tied to Japan. A couple of other quick notes. All right, I know that there was a question in here, but I'm going to move on. You guys are still going on with Warren. All right. Why do they got to expand it so fast? I don't know where you guys are, so I apologize. If you have a question, type it. All right, Meta, AI strategy turmoil. They are shifting their focus from its AI llama models to a new system called Avocado. Okay. Billions are being invested with unclear strategic direction. And look, this is all going back to the exact same story that we told before. These guys are just spending money to spend money at this point. This was a catastrophic effort a couple of years ago when they were trying to move into the metaverse. Stock absolutely tanked, absolutely blew up. Jim Cramer cried on air. And then the liquidity cycle returned. And what happened? Everybody bought back into Meta. Well, here's the thing. We might be at the top of the liquidity cycle right now, according to Michael Howe, according to some other people. And what does that mean? It means what has gone up can and will go down. Meta's trading at 29 times earnings, which isn't unreasonable for a name like that. But this is kind of the dark abyss of them just continuing to just throw money at bad money at good things. They have competitive risks. Meta will be a name that if the market momentum goes negative, I will be looking to short. NVIDIA. President Trump has said that NVIDIA may ship H200 AI chips to China if the U.S. gets a 25% revenue cut. Whoo, boy. Man, that's this is some Goodfellas stuff. AMD and Intel expected to fall under similar frameworks as well. And a lot of things are changing on the geopolitical front right now with China and the U.S. China reportedly responded positively. This creates a industrial policy structure. This is important, and it injects more uncertainty into the global AI supply chains. One of the big problems is in this environment, policy is just not trustworthy. It is changing on a whim constantly, and it's very important to just keep this in mind. There really does appear to be people front-running some of this stuff. So if you see unusual options activity, and I'm talking way out of the money, that is tying to some of these names, it's very critical that you pay attention because that could be a tell of some policy shift. We have seen some front-running, and we have also seen some significant insider buying activity around certain stocks that have benefited from policy decisions, names like UAMY. Again, the continuation of this policy, it is a lot of knee-jerk reactions, and it's kind of got a Calvin ball feel to it in that the rules are different every time, and the points don't count. Gold, of course, I am watching. Gold is pushing higher as traders are hedging policy risk, the dollar softening, real yield slipping to support the move. Metal strength across silver, platinum, and gold. Gold often moves first when the macro sentiment shifts. Silver is pushing 60. It's trying to get to 60. And you're seeing a lot of people complaining and barking about what's going on in the London Metal Exchange. Key thing here is, I don't know what's going to happen. I just know that there is a lot of pressure to try to keep a lid on silver prices. If we break through 65, we will get to 70, possibly 75. Very quickly. A dovish Fed could lift gold further, and a hawkish surprise obviously could impact gains, take us maybe back to 4,000. But as I remind you, as always, all roads point to more monetary policy easing in the future. I anticipate that by 2030, the Fed balance sheet will be at $10 trillion. Garrett, all the roads lead to the Oval Office for the inside trading. Well, yeah, that's one way to put it. DUOL. I'm not disagreeing with anybody. But you can predict the weather. You can predict natural gas prices. DUOL. Hey, where are you? Secret Agent Charlie. So this thing exists. Software. And these names, this is where we're getting a little bit of momentum return. We have seen some names getting absolutely pummeled in the software application space. Really high metrics, really high earnings, price to earnings ratios. Some of these names now are getting down into these regions where they're deeply oversold, and we're looking for a possible just reversion somewhere maybe back to 250, maybe even higher. Remember, stocks like this, lower highs, lower lows. But the key thing, monetary easing will have a effect on precious metals. Printing more money will have a expansion on precious metals. So too does fiscal policy, which has been manic for the last couple of years. We wrote something called the Hedge of Tomorrow that kind of explains this last March when gold was at 2,400, maybe it was 2,100. We went very aggressive on gold and silver after the fiscal policy changes created by Janet Yellen. Very strong momentum here on Duolingo. And, I don't want to, this is going to be a tough one, largely because the Fed meeting is going to dictate so much. But I think just in this world, what you're looking for, this is a name to add to a list for tomorrow. We're looking for this positive crossover. It has not had a positive crossover on the 20-day EMA going back to last April, and then had a nice positive run. It just screamed higher, 300 up. I'm not predicting something like that, but a retest of that 100-day moving average is certainly back in play. Buying the stock at 206, setting a tight stop back at the EMA 20 of 199, 199.81. And yes, just buying the stock. I'm not going to, I know this options chain is a mess. There's a lot of names in the technology software application space that have taken this type of hit in the last year. Moves down from like 550, 600, 66 to 70% declines. That's kind of where you have to start looking under rocks and seeing if there's actual value there. This is all obviously hinting toward broader slowdowns in U.S. Consumer spending and business spending as well. All right, let me get out of that. And technology's weakening, so I got to be a little bit cautious about that. On top of that, you have our good friend Walmart. Oof, Walmart. Low prices. So many deals. The big news is Walmart has joined the NASDAQ, which means quite a bit. Should be pretty active as a result. I like Walmart, not just to go see the people. No one works there anymore. It's so bizarre. You just walk around and can't find. I don't know if that's the plan. Who knows? But Walmart's a pretty easy setup because, once again, this is your largest consumer defensive retail name, and it's also your largest grocery store in the United States. I don't care if the stock goes down. I'm going to keep accumulating it. I've been long Walmart since about 60. So what do I do in this environment? Well, again, if you're uncertain about the Fed and you have questions and you're trying to figure out what to do, okay, well, go out to February and do something as simple as sell the $100 put and buy the 97.50. And what does that do? Well, I'm going to do a couple of these trades. Now, instead of spending $11,418 on 100 shares, I can do 2 of these positions, 3 of these positions, 4 of these positions. And the way that this is set up down here at that key moving average, and again, we've seen Walmart sell off. We've seen this stock bounce off its 100-day and ride higher. This, of course, was a major liquidity event. Once again, if you have another one of these events, the central bank or other central banks will create a accommodative policy to prevent a massive debt deflation spiral. Walmart's not trading at the most unreasonable. It is a little tricky when you get into some of these metrics. 40 times earnings, yikes. But if you sold the 100, bought the 97.50 put spread, probability of profit for February, that's what we're talking about, February 2026, 197 put spread, 93% probability of profit, 12.5% return, break even at 99.73. Not bad. Quiet, cheap, inexpensive trade that you could do over and over and over again. All right, last thing. Pepsi. So activist pressure on Pepsi, right? There's been some agreement that they will make some layoffs, reduce their SKUs, and this is Elliott involved, which isn't shocking. Elliott will go after the SKUs very quickly, and some of this stuff is actually really common sense for the activists to be doing. I thought that they probably were going to push for Frito-Lay to spin off because that's where the money actually is. But think about a company like Frito-Lay and think about the companies like Pepsi. This is a rock solid case study in a company trying to do too much. How many 95 flavors of Pepsi do you need? You don't. You don't need all these experimental chips. Just stick to what you're good at. They're going to do supply chain analysis, and it's going to be relatively solid, right? But I don't know how quickly this is going to happen. I am not wild about Pepsi as a company or a stock, but right now, just kind of the way that this is trading range bound, it's an interesting name to potentially sell a spread down here and then buy a call up here. Take the proceed here. Was that a broken lizard trade? Jaded lizard? Jagged lizard? Sell the spread that you're willing to take the stock at and then use that proceed to buy a call. If we stay and break above 147, that's where I would look to go long on a call option, maybe up to the 150 level. A little bit of a hero trade. Can't go wrong there. All right, some other things to watch. Home Depot under some pressure. Blue Owl, lots of puts. Lot of puts have been purchased on Blue Owl. And once again, this is probably one of the more important stocks to watch over the next month and a half. And I just want to explain why. Blue Owl is one of those names in the private equity / alternative assets / private credit business. When we started talking about all of this in the repo market and what was happening, Blue Owl was getting crushed. Now, I'm a long-term shareholder in this company. That said, I have not enjoyed watching this thing fall below where I bought it in April when it was at 16. That said, Lots of insider buying has transpired in the last week and a half, 2 weeks, but a lot of puts have been purchased on this. And here's the problem. If the Federal Reserve doesn't get its stuff together and we see a rollover, particularly in the financials, these private credit companies are not out of the woods yet, Blue Owl especially. This is where most people believe the next major crisis is going to come from because of the lack of clarity in what these guys are actually doing, the lending terms. And we've already had a number of things already blow up so far. The thing about this is just a preview, because if this liquidity cycle is topping and now rates are going to have to shift internationally, like they likely are going to in Japan, and banks around the world, which have largely been easing and providing pathways to higher liquidity and higher equity flows internationally, are now going to start to constrict as well. Then we got an issue. We have an issue. And it would be a preview of what is likely going to hit next year. Now, I know that's a long way away, but I think what's very beneficial for people is to take a look at where you are right now and then look at some of the places in the past. 2007, the writing was on the wall. We saw collapses of mortgage businesses. We saw some things go up. Almost used a word. But it was a preview. It was a preview of what would come a year and a half later. And interestingly enough, liquidity was pretty robust at the onset of 2008. It all froze up very quickly. Now, the reality is the Fed and all of these other central banks can't just allow a constant expansion of liquidity and capital because of the inflationary pressure. So in the world of the cycle, and we're going to go back to Hal's cycle real quick, there is your liquidity cycle of advanced economies going back to 1965. The argument is you have 65-month waves, and this is his GLI, his liquidity index. And as you can see, we don't always expand to that peak, right? That is the 2021 peak, which, by the way, that's how 2022 took us into the gilt crisis so quickly and so abruptly. This is where we are right now. This right here is the most recent dip that transpired because of all the concerns we had about the repo market and Japan. Whether or not we can get back up here, that's to remain seen. But that said, the trend will be to this direction. And that takes us into 89, 2005, 2006, what happened with Europe, what happened here with China, what happened here with our domestic markets. We will be back in this range at some point, and risk assets will take a bite as it. This is how the markets have worked since the 60s. Just nobody takes the time to really think about it. This is the boom and bust result of monetary policy, of a fiat currency, of expansion and tightening and expansion and tightening. Risk assets follow that. And today in the post-2008 world, markets largely front-run liquidity expectations. If there's going to be more money, more credit, more capital, that money flows into risk. And if there's not, it flows into duration. It flows into bonds. So yeah, there's going to be a point next year where you are going to have to look at the cycle itself and say, where do I move? Typically at this point, the defensives should start to move. The defensives are usually the place to go, the consumer defensive stocks. But here's the problem. Every time that you have a Western central bank like Japan step in and print, which they just did, what happens? The stocks with the highest short interest go up. The tech stocks rally. The high beta goes up. And the defensives, ironically, go down, face pressure. They have faced pressure since late November. Not huge pressure, but enough to showcase that we were starting to see a very solid move on the consumer staples as those credit concerns built. And then when Japan stepped in, we've seen a little bit of a sell-off and, of course, a rotation into HIBL, the high beta ETF. Do you see it? Do you see what happens? Do you see, Larry? You see what happens, Larry, when you print money? This is what happens, Larry. This is what happens, Larry. This is what happens when you print money, Larry. If you don't get that reference, I can't help you. All right. NVIDIA, PSKY, and LUV are our other watch list stocks. And that's going to take us to the last part of today. And this is just a reminder, and I talked about it yesterday at 3 o'clock. But volume-weighted average price, everybody. I can't make it any easier for you. This is, again, something I learned a couple of years ago. One friend of mine was a master of trading it in earnings, Kenny. Then I started to study it academically. And I really started this after we heard Mr. Druckenmiller back in 2018 in his Real Vision, which is one of the most important interviews in the history of financial markets. If you don't know, well, now you know. But in 2018, Druckenmiller had pointed out that, look, this is a guy who beat the market for 30 years. 30 years. And what happened? Well, he explained that there was an algorithmic apocalypse. He said a lot of these algos apparently are based on standard deviation models. So just when you think they're supposed to pile on and lift off, their models must tell them. Because your 3 standard deviations from where you're supposed to be, they come in with these massive programs that go against the beginning of a trend. On Thursday, the 4th, we saw the SPX tank. And it hit the 4th standard deviation. Remember, this blue line that you're looking at, this blue line, is volume-weighted average price. This is, it's been described as a magnet. It has been described as an institutional defense mechanism. That blue line. Now, I have the Bollinger Bands on it as well because when I add the Bollinger Bands, it adds another deviation barrier to it. But as you could see, the SPX on Thursday sold off, tapped into the 4th band, and then immediately turned back around. That was what Druckenmiller was talking about. And if we look at the SPY, what happened that day, what it gives us is a better representation of movement. If the SPX goes into that 4th band, that is where the SPY, you buy whatever is at the money, could be the 681 in that case or even the 682, and you look for a move up. And that was a $2 move on the SPY in about 15 minutes. You can do a lot with that. That's what you're looking for tomorrow. You're looking for tomorrow a bit of an overreaction at 2:30, maybe even at 2 o'clock. But we have seen moves of the S&P 500, of stocks like NVIDIA, of the NASDAQ, move lower. And if you add the Bollinger Bands, what you're looking for is a move outside of those 2 standard deviation lines and a move either back to this adjusted SMA, 20 SMA, and or a move back to volume-weighted average price. We will look for that overreaction. I will be back tomorrow for the Fed meeting. We're going to trade this live. I think I'll be here from 2 to 4. And we're going to look for this opportunity. And you got to be quick. You got to be willing to kind of trust the process. But we have seen moves, violent moves, $7, $8, $9, $10 moves on the SPY. And if you buy into a specific call option, you're looking at the possibility of not 50% win. You're looking at the possibility of multiple 100%. And it's all about just waiting. Can I guarantee it's going to happen? Absolutely not. But I'm positioning myself with these very specific conditions. That's it. If it doesn't come, it doesn't come. We wait till another day. But we've had wins like this in the past, and we're going to look to try to take advantage of it tomorrow. All right, everybody. Don's coming up. I believe everything is well now on the island. I think we're okay. So that will be good. I will be back at 3 o'clock today. I have some trades on NVIDIA today as well, and we will go from there. I hope everybody has a great trading day. Thank you all so much, as always, for joining me in the morning. I will catch up with you later today, 3 o'clock. If you're not a member, name your price, click the link, and be a part of this. In addition to that, be sure to click on the presentation, the Matrix Key, how to trade less but make every trade count more in 2026. Have a great day, everybody.